everybody. Thank you so much for joining us for our AT&T webinar today. My name is Samantha, and I'm in Client Services here at the Retirement Group. I will be moderating this webinar for you today. You'll see me throw some useful links into the chat. One will guide you to book an appointment with an advisor after this presentation. The second will be a link to our education center where you can view a full library of all of our past AT&T recordings. And another is a link to our LinkedIn account where you can follow us and get updates on all of our upcoming webinars and presentations. Our speaker today is Tyson Maybar. He's going to be speaking to you, AT&T employees, about the decision you may be facing currently about whether to return to office or retire. Tyson will be guiding you through this decision, exploring financial impacts and personal goals to help you make the best decision for you. Before I bring Tyson on, I need to just remind you quickly that although we have extensive knowledge here at the Retirement Group of AT&T's retirement plan, and although we work very closely with both active and retired members of AT&T's community, the Retirement Group is not affiliated nor endorsed whatsoever by AT&T. We are a completely independent group of financial advisors. And after Tyson's presentation, I'll be coming back on to ask him any questions you may have entered into the Q&A box throughout his presentation. Please feel free to ask away. It's completely anonymous. We love answering the questions. So please ask away. And without further ado, I'm going to introduce you to our speaker, Tyson Maybar. Hey, Tyson.
Hey, Sam. Thanks for the introduction. And thank you folks for attending our webinar series today. My name is Tyson Maybar. I'm one of the AT&T focused retirement advisors for the Retirement Group. And on today's webinar series, we're going to talk about this big decision that a lot of our clients and our prospective clients from AT&T are being faced with now, which is whether to move, go work somewhere else, in many cases in a different city, or leave AT&T in this unprecedented decision by AT&T to return to the office. So we'll talk a little bit about what we know about what's happening with that, as well as some of the decisions that you're probably going to want to consider as you approach potentially leaving the company. And even if you're not leaving the company this year, these are things you're going to have to go through eventually anyway. So we encourage you to still listen in, as these are very important decisions related to the retirement process at AT&T and building a successful retirement plan as an AT&T employee. For those of you who aren't as familiar with us, the Retirement Group is an independent financial planning organization that specializes in helping corporate employees manage their retirement assets and transition into retirement successfully. We've actually been doing that for over 30 years with AT&T folks. That was the first company that we started working with back in the early 90s. We help employees of other companies, but that just happens to be the one that we have the most experience working with folks from. And we have a whole host of complementary services we encourage you to take advantage of, whether or not you're approaching retirement, because eventually you're going to leave AT&T and there's a lot of decisions that you'll go through. The cash flow analysis is what I think we can add the most value to your plan in going through. It's a complimentary service. We'll ask you some questions about your situation, help walk you through the Fidelity website to gather the information we need, and we'll put together a game plan for you. And this is going to not only help you decide the best time to leave the company, but it's also going to help you improve your position to leave the company, whether by changing how you're saving, how you're investing, understanding the different benefit options, especially with the pension plan, an irrevocable decision that you definitely want to be prepared to make once you get to the point where you have to make it. And some of the other decisions that you'll have as you approach the transition from AT&T, whether that's into retirement or into another job other than the one that you have at AT&T. We also publish these webinars on LinkedIn, so follow us on LinkedIn if you're not doing so already. The QR code at the bottom of this slide, if you take a picture of it, can get you to our LinkedIn page. And we'll publish on there not only specific webinars related to AT&T benefits and retirement planning, but also generic retirement planning, things like estate planning, tax planning, investment planning, and our investment philosophy. A lot of great content on there. Take advantage of it if you're not doing so already. Now, when we're building this retirement plan, we like to go through a checklist of the important aspects of a retirement plan. And on the very top of that list is comfort and emotions. Unfortunately, we found that as humans, we don't always make decisions that are in our long-term best interests because of how our brains are wired, because we are emotional creatures. And sometimes we make decisions based on our current comfort versus what is going to be in our long-term best interest. And ultimately, sometimes decisions that we regret. A couple examples of this, having too much money in our company stock. We see that often. Making a decision when to retire that's not in our long-term best interest. Sometimes it has to do with the interest rates that affect the pension lump sum. Sometimes that's taking a package that we can't afford to take. Other times that's not taking a package that we otherwise should have taken because it would have improved our retirement plan sustainability. So understanding the emotions that drive some of our decisions, we found helps to improve our decision-making process and have a better retirement experience. As retirement income advisors, we're looking to ultimately reduce risk. And at the top of those lists of risks is the risk of running out of money or outliving our retirement assets. There's a lot of different ways to do that. One way is to reduce the volatility in the plan, although you may need some volatility in your investment allocation because that's how you get growth in many cases. So volatility minimization is not our only objective. We also want to reduce the risk of inflation, what that does to our purchasing power, reducing the risk of taxes, what that will do to the amount of money that we get to keep in retirement. And for most people, number 3 on the checklist, the optimal or the most important goal in retirement is maximizing retirement income, just having the biggest retirement paycheck possible that's still sustainable. In other words, it's not going to run out. It's going to give us some longevity with our retirement plan to get us out to a reasonable age, and maybe even having some lifetime income, whether that's through the annuity option on your pension or some private annuity that you purchase with a portion of your retirement investments. Building this plan is essential so that you're not ultimately running out of money. This is our biggest concern as retirement income advisors. Taxes play a big role. We see some of the biggest mistakes people make overpaying in taxes, and typically it's just because people don't know the rules. By understanding the rules, you could typically find a more efficient strategy of creating retirement income and minimizing your tax burden while still paying your fair share in taxes. But there are a lot of rules. Part of our job is not only to know those rules, but to communicate them to people based on your situation and which ones are going to apply to you. And then at the end of the day, my job as a financial advisor and a representative for my clients is to understand their objectives in retirement, the things that they want to do, the people that are important to them, and in some cases, they're relying on them for financial help. I need to get to know what's important about your plan for you, maybe you and your spouse, maybe you and some children, causes that are important to you, when this money needs to be available, and then pivot from time to time based on the changes that come our way from a perspective of tax rule changes, changes to interest rates, changes to inflation, changes to the economy and financial markets. Whereas I have colleagues at the company that don't know our clients at all. All they're doing is the analysis required to make the investment plan a sound one that is efficient for each of our clients' individual needs. So to build this, we first need to run a cash flow analysis, and then we can start to understand the dynamics of your and your family's plan, and then we could start to give advice based on the specifics of your situation. Today, we're going to talk a little bit about this return to office policy that's being implemented at AT&T. We're going to talk about lump sum interest rates and some of the pension decisions that you'll have to make either when you leave AT&T or sometime later after you leave AT&T. We're going to talk about inflation, the risks that that brings, as well as some of the opportunities as a result of higher inflation that we've seen in this last couple of years. Talk about the issues with the 401k plan and the tax implications of both accessing money from that plan and moving money out of that plan should you choose to do so after you leave AT&T. And then ultimately, the biggest mistakes that we've seen people make and why some find it critical to have an investment team like the retirement group to help prevent financially detrimental decisions that could destroy your retirement plan when the time comes. And when we build this cash flow analysis, we first need to understand your source of funds. Most people we work with at AT&T at least have a 401k plan that they've been putting money into, and the company has likely been matching you. The pension plan, not everybody qualifies for a pension at AT&T, but there are a number of different ones, and we understand all of them. So we're going to ask you some questions about your career with the company, which plan you're on, and then we can communicate to you the options you have with your plan, the risks of your plan, how interest rates affect your lump sum as an example, the timing issues with this plan, and how you might want to consider utilizing this plan, whether you take it as a lump sum or as one of the annuity options, how it's going to play a role into your production of cash flow in retirement. Real estate is, for a lot of our clients, also an asset, at least the equity that you have in your real estate. You may have at least a primary residence. Some of you may have investment properties. And although we don't want to rely on the equity in your primary residence, as an example, as a source of income in your plan, it needs to be considered for the purpose of what decisions we're making with the other sources of funds. And you may also be considering moving once you're not tied to a job. For those of you, especially that are being forced to go back to work in the office. In fact, I know one of my clients volunteered to take a package last week. I know a lot of people unfortunately lost their jobs involuntarily on July 6th. One of my clients who was leaving the company on that day actually chose to take a severance package because for a variety of reasons, not wanting to go back to work in the office and just wanting to do something else. And his plan worked out to allow him to be able to do that and make substantially less money at the next job while still maintaining a very sustainable retirement plan, something our cash flow analysis helped to answer. But understanding the real estate impact on your source of funds, and also understanding the 401k plan and Social Security, a big one for anybody who's been, if you worked at AT&T, likely contributing to Social Security. And your spouse may even get benefits, even if he or she didn't work over the years. And there's also survivor benefit Social Security that needs to be considered in building this plan for income throughout your retirement. So we're going to talk about a few of these today. Now, this return to office policy, we still haven't hammered out all the details on this, and it appears to be on a case-by-case basis. Not everybody's affected by this, fortunately. Most non-management employees that we've talked to have not been affected by this. There are many managers that are also not affected by this, but I have talked to a number of people, probably over 20 people in the last month, that they already know that they're going to be displaced. They are not going to be able to keep their job if they're not willing to move to one of a number of different cities. So we'll talk about this, as well as the implication of this return to work push that is not just at AT&T, at many companies today. This post-pandemic era that we're living in, and companies trying to get people to work in the office once again. So these mandates we've seen, it's going to require people to physically go into the office. Many people have gotten very accustomed to being able to work from home, and it was a delight for a lot of people. Not everybody is best suited to work from home. Some people are more productive from home. Some people are less productive from home. But the company has made a decision, and whether it's as a result of having more productivity or innovation in the office, or potentially just a sneaky way to reduce headcount, this is what we're seeing this year, and it's potentially going to affect around 60,000 employees across the country. So not everybody, but a good number of employees are going to have some pretty tough decisions to make pretty soon here. In fact, I heard just this morning that there's some people that are going to have to be working in Dallas, and I live in Austin, Texas. I work with a lot of people in Texas, but also people around the country. There's some people that are going to have to be working in Dallas by August 1st, I understand. Otherwise, they're out of a job, and that's only in a couple weeks here. And there's other hubs, not just Dallas, Atlanta, El Segundo, New York, where a few of the others that are these primary hubs that the company is going to try to focus getting people working from, to consolidate their employees into a number of different regions. And it's just not going to be feasible for some people. Now, employees that are close to retirement face some big decisions here. Now, if you're younger, it may be very easy for you to go just get another job. You may not even have qualified for or vested for the pension yet. It might not be as big of a deal to go work for a different company other than AT&T for you. But if you are close to Mod 75 or close to your service pension eligibility, you need to look at a lot of different factors here. You need to look at, when you meet that service pension eligibility, you can see it might be worth staying on. You want to also figure out what it's worth to you to get to mod 75. I ran projections with somebody the other day. We found out their pension was growing over $300,000, and they reached that criteria next year. So $300,000 to them was worth living in a different city for 1 year, close to a year, and probably leaving the company and moving back home and taking the money. And in their case, they're going to have to continue working somewhere else, but at least they kept that $300,000, and they're only displaced for a 1 year time. Everybody's situation is going to be different on this, but this is what you've got to look at, in our opinion, to make a sound financial decision on the costs and benefits of staying with AT&T versus leaving AT&T. Now, for a lot of people, this is just going to encourage you, for some people, to put together a retirement plan for the first time ever. And if you already had a retirement plan, this may encourage you to change some things in your retirement plan. It may mean working a little bit longer as a result of having to take another job that pays you less. Maybe incentive to retire earlier than you thought, if the numbers work out. You've got to know how sustainable your plan is. This is why we think it's critical to run this cash flow analysis. And there's broader implications, not just AT&T. We're seeing this happen throughout the industry and throughout our economy. Companies, many of them not forcing people to move to a different city, but at least not work from home anymore. So we're expecting to see less and less opportunity for people to work from home by many companies instilling or returning to the policies that they had prior to the pandemic that allowed people to work from home these years. Although I've seen at AT&T, one person I'm working with, she had been working from home for over 10 years, well before the pandemic. And now the company is no longer having that be acceptable. So, you know, there's probably a variety of different reasons for this, a variety of incentives why the company is doing this, but this is where we are. And our best advice is to put a game plan together, look at different scenarios on when's going to be the best time to take your pension, how to create income if you do lose your job, which, as it appears, everybody that I've spoken to that knows they're going to get displaced has confirmed that they're going to be getting a severance package. Now, I can't confirm that that will be across the company, but it seems that that's going to be the case. Folks that are not able to move and decide not to return to the office, who are leaving the company, are probably going to be getting somewhere close to a 6-month severance package, depending on the number of years of service you have with the company. But understanding the money side of these decisions is critical into not regretting any of the decisions in the future. And this is maybe a pivotal point in your career that you want to spend some time understanding the potential benefits and detriments of different decisions related not only to staying at the company, but how you treat your money after you leave the company. So let's talk about the pension a little bit. Many of you know the pension lump sum. There's a lot of different pensions at AT&T. The cash balance plan, which affects a lot of people, does not have this relationship. But if you're on one of the defined benefit plans, so the CAM plan, the career average minimum plan, the ALM or AT&T legacy management plan for legacy T folks, and those are the two big ones, but there's a number of other pension plans that are what we call defined benefit plans. They're formula-based plans that the lump sum has a negative correlation with interest rates, meaning that when interest rates go up, the lump sum goes down. A lot of people saw big losses on their lump sum last year when the company changed the rates that they use to calculate lump sums in January based off of the November corporate bond interest rates. Those will be changing again January of 2024 based on the November 2023 interest rates, which of course we don't know yet. But this may be a reason to consider deferring the election of your pension if you're leaving the company. I'm going to zoom into this table here where we're looking at the top of the table. This is what we know, the most recently available data on interest rates. The first, second, and third segment rate, you could see 4.91, 5.15, 5.34. In a couple weeks, we'll have June data. A month after that, we'll have July data. And around December 20th, we will have November data for this year, which is going to be the data that is relevant, the numbers that they will use to calculate next year's lump sums. So we track this throughout the year just so that we can have some kind of an understanding of where interest rates are going, and does it make sense to leave now or take the pension now, or does it maybe make sense to defer the election of the pension? What I mean by that, I have a client that retired last week. He left the company on July 6th. The decision that I educated on was to wait 6 months and see what happens to interest rates. We know, you can see here, comparing to November of last year, all three segments have come down a little bit. And we actually modeled his pension on January 1st to see how much he was making. I think it was about $10,000 on his lump sum if interest rates did nothing. Now that's pretty unlikely they'll do nothing. They'll change a little bit. But we don't know if they're going to go up or down. So the risk in waiting is that your lump sum is going to go down if rates go up, which of course you could still take the pension before the end of the year to prevent that from happening. But you would have lost out on about 6 months of interest if you had otherwise rolled over your lump sum, either to your 401k or a traditional IRA. Even if you're putting that into a money market account or a CD, something very safe, you can earn, in many cases, close to 5% annualized right now, which wasn't as good a couple years ago. So this is the silver lining on higher interest rates. Unfortunately, lump sums have gone down, but your ability to generate income on that money has gone up in the last couple of years, which is precisely why the lump sum payouts have gone down. But you don't have to take your lump sum right away. Now, an exception to this, not all plans allow you to defer your pension forever. And I'll give you a couple examples of this. Most plans that AT&T has, most pension plans, you have to take your pension or commence your benefit, technically they call it, by age 65. So if you're approaching or have already passed age 65, you're probably going to have to take your pension right away. You can't defer your election until a later year. For instance, in this case, if we are seeing interest rates are going down and you expect a lump sum to go up. Another example, many of the craft pension plans, and I have a lot of management clients that have two pensions, of both a craft and a management plan. Many of the craft plans force you to make a decision to take a lump sum within 90 days of your retirement. And if you don't, you lose the lump sum option. So those people would not have the option to wait to see what happens to interest rates this year and hope that they go down so that their lump sum is higher in January. So there's a lot of intricacies and moving parts here. This is why it's critical to work with an advisory team that understands the AT&T benefits. And the retirement group, we're not the only one out there, but we've been doing this for over 30 years with people in a similar situation as yourself, working with clients from AT&T. And we have thousands of clients that have gone through a similar situation as you have. And we hope that we can add some value to your retirement strategy. We think we could do so if you just spend a few minutes with us. Here's a chart on what's happened to the rates. The first, second, and third segment rate. You can see, interestingly enough, the second segment rate actually went higher than the third segment rate, which is not common, but happens from time to time. And although rates were historically incredibly low during the pandemic, and although they went up dramatically last year, they're still not that much higher than they were in 2019. And they're still lower than they were even in some years that I started with this company in 2011. And we saw people taking lump sums in an interest rate environment that was even higher than the one that we're in today. So although if you're comparing to the recent past, that lump sum might not look as attractive as it did a year ago, 2 years ago, but still may be worth considering depending on your circumstances, of course. It's not going to be right for everybody. I have a client the other day that told me that he doesn't trust himself to be able to manage or not spend that money too quickly. He's probably not a good candidate for the lump sum. And there's a lot of other reasons you might want to consider the annuity options or one of the annuity options on the AT&T pension plans. But the lump sum is appropriate for a lot of people, and understanding the merits of the different options is critical. Not only the merits, but also the timing of the election of this plan, critical in maximizing what you walk away with and not having regret in the future because you chose the wrong option. Now, a lot of people more so recently have been communicating to us their concerns of inflation going forward. This is a big concern. I've heard a reason why people want to take the lump sum. Because as you know, the annuity options at AT&T are not indexed for inflation. There's no cost of living adjustment. They're fixed for the rest of your life. So the company tells you you're going to get $4,000 a month, for instance. At retirement, it's going to be the same $4,000 a month in 30 years and might buy substantially less goods and services in the future, because as prices go up, that $4,000 isn't going to go as far. The higher the rate of inflation, the faster that value of that pension is going to deteriorate. And this has been a big concern on a lot of people's minds lately. As it turns out, inflation has other implications. Has implications on which types of stocks do well. Some companies do better than others in a higher interest rate environment, which happens to correlate with higher inflation. Saw inflation go up to 40-year highs last year. And we also saw interest rates climb faster than they've gone up in 30 years in an effort to curb inflation. And here's a quote from T. Rowe Price: "Many fixed income investments do poorly in a climate of rising prices because bond prices generally decline as interest rates go up. Inflation also affects the value of the bonds in our retirement portfolio. And while traditionally people have expected their bonds to be the safe portion of their retirement portfolio, in a rising interest rate environment, this is not the case. And you probably saw this if you have bond funds, or there's one bond fund specifically in the AT&T 401k plan, got hit pretty dramatically. This will continue, very likely, if interest rates continue to rise, to get inflation back in check to where our Federal Reserve has communicated they want it to be, which is 2% annual. We're not there yet. We're still hovering right around 4% annualized inflation. So we don't know if interest rates are going to continue going up, if they'll go back down, what's going to happen in the meantime. But we encourage you to A, watch closely with what's happening, because it could govern your decision making, and B, understand the implications of these changes so you can make good decisions that might impact the sustainability of your and your family's retirement plan. Now, lastly, we want to talk about the 401k. So there's some special, let me zoom in or go to the next slide here. There's some special tax situations that allow people to get money out of their retirement accounts without penalties, even before age 59 and a half. There's 9 specifically that we talk about here, but I want to focus on 2 of these. One of them is called 72T. This is very important for somebody who leaves AT&T prior to the year they turn age 55. So you do qualify for a special tax strategy if you retire on or after the year you turn 55. If you leave AT&T specifically on or after the year you turn 55, you could take penalty-free money out of your 401k plan. And for managers, they let you do that 8 times per year. Plus, they also allow you to take monthly withdrawals. So technically, you could take money out up to 20 times per year if you structure it correctly. Fairly flexible enough for most people that I've worked with who did leave before 59 and a half, but also needed some income prior to 59 and a half. This is a good way to do it. If you're not 55 or not even 54 and turning 55 later in the year, you might want to consider another exception to this rule, which is called 72T. This is a way that you can produce an income stream that's penalty-free. Still have to pay federal taxes and potentially state taxes if you live in a state that taxes retirement account withdrawals. But you can avoid the 10% early withdrawal penalty. The problem with this one, though, and why it's not as good as the previous strategy I mentioned, the post-55 strategy, is because you're on a fixed income until 59 and a half or until 5 years, whichever is a longer period of time. You're only going to be able to take out what your 72T income schedule allowed for. And government rules allow, and they're going to use interest rates. Higher interest rates create higher available payouts, fortunately. So that's one of the benefits, interest rates going up. These are more suitable these days, these 72T schedules. They're also based on the account balance that you commit to this program. If you have $1 million, but only commit 800,000, for instance, and leave 200,000 in a separate bucket, that could make some sense, an emergency bucket, we call it. But it's going to reduce the amount of income you can get on a penalty-free basis by creating that emergency account. And it's also going to be based on your age. The younger you are, the less money they let you take out. So with those factors, we can calculate for you how much penalty-free income you can get using a 72T. And for a lot of people, this is not enough to live off of. So many people have to supplement that 72T income with either a future job, maybe a part-time job, maybe their spouse is still working. Oftentimes they'll have to cut some things out of the budget, but there's a lot of good strategies in the tax code that allow people to keep more of your money by paying less in penalties. So talk to us if you're not sure how these work, or if you want to build a retirement plan based on your situation. Now, when you leave the company, like I mentioned earlier, most people don't have to roll over the pension right away. In some cases, it might make sense to, though, to either start earning interest on that money as soon as possible, or to start getting payments, your annuity paychecks, as soon as possible. You might have to if you're over age 65. You might want to if your plan requires you to get the lump sum, to do it in a timely fashion. The 401k plan does not have to be rolled over right away either. I encourage people to do your due diligence on meeting with usually multiple advisors so you can see who is the best fit. It might not be the retirement group. We think we have a pretty good story on why you might consider us, though. But don't rush into any decisions, because a lot of these are irrevocable and you don't want to have regret with some of these decisions. So you might want to just leave things where they are and let the dust settle from your transition from AT&T, to buy more time to make good decisions on how to invest the money, where's the money coming from, what's your tax and distribution strategy going to be, and ultimately, who are you going to work with to help keep you out of trouble in some of these very big and, in some cases, irrevocable decisions that are coming up. Now, there is no taxes when you roll over your 401k to an IRA in most cases, and there's typically no taxes when you roll over your pension lump sum to an IRA either. There's a couple exceptions to that. If you're a really highly compensated employee, sometimes they won't let you roll over the entire amount. That's called IRS 415 limits, and we'll help you identify if you fall under those. But for most people, you can roll those over, pay no taxes at least immediately, continue deferring taxes on that money until you withdraw the money from the individual retirement account. It's also possible to roll your pension lump sum into your 401k, and sometimes advisable. So talk to us about that if you're not sure what's going to be the best way for you to go. And it's also really critical you understand the costs of all your different options, because that has to be on your checklist of things to consider when deciding who to work with, what investments to use, not just the performance on those investments, but the cost, because those costs are going to eat into your growth over time. So you want to minimize them, but you also don't want to go too cheap, because that could also have costs associated with it. And then ultimately, like we talked about working with an advisory firm. Not everybody has to work with an advisory firm. Some people love what I do for a living and have a second job in retirement. That's their job, is to manage their investments, manage the distribution strategy. And some people are cut out for that, but the stakes are very high. A lot of these mistakes can be very costly, especially with the tax rules and issues. And so this is the reason that most people hire some help, a team of professionals that not only understand retirement income planning and investments, but maybe not a bad idea to hire somebody that understands the AT&T rules, so you don't make any costly or irrevocable mistakes upon your transition with the company. I've seen countless examples of that. Getting the election paperwork incorrect when you elect your pension, rolling the money over into an incorrect account. Even good financial advisors will still be subject to these mistakes if they don't have clients from AT&T and haven't gone through this process before. Here's a list of some of the things that people that we've worked with in the past told us they were looking for from their advisory firm: understanding the benefits we talked about, understanding that they work with an investment team. It's not just myself at the retirement group. We have not only a team of advisors that are doing the investment planning and selection, but we have a network of advisors as a succession plan for myself. If I get taken out, or if I leave the industry, something happens to where I can't continue to monitor my clients' accounts, I've got a pretty deep roster of advisors that are very skilled and have a track record working with people in a similar situation. And I'm their succession plan just as they are mine. But having a network of advisors throughout the country, we found people, a reason they like to work with us, because we have a pretty large company. We're also not the big company where you get treated like a number because you're one of 100,000 different clients. That's not the case either. Detailed financial analysis. Don't pay for a financial plan, folks. Ours is complimentary. It's very good. It's tailored specifically to the AT&T plan. There's a number of companies that'll do something for you similar, also for free. But there's also companies that'll charge upwards of $2,000 for something that you can get for free. So don't pay for it. We're delighted if you're willing to spend some time with us to put this together for you. So just let us know and we'll let you know what we need to put that together for you. Unfortunately, statistically, 74% of Americans do not have a written plan for their retirement. And that's 74% of Americans over the age of 50, which is crazy to me, but still is the case apparently. And the way that you avoid this is by calling us, having us run your cash flow analysis, and putting a game plan together so you understand the things that we think are important for you to consider now and as you approach your transition from AT&T. There is probably some things you could be doing today, even if you're not leaving AT&T this year, things you could do now to improve your position to retire, whether it's how you're saving in the plan, the taxability of your contributions. You might want to consider an in-service rollover from your plan. It's where you move money from your 401k to an IRA or Roth IRA, even while you're still working. That's available to most people that we talk to, and we can show you where to see if you qualify for that and why you might want to consider it. So spend some time with us, folks. We are fairly confident it'll be a good investment of your time. And all we ask, there's no obligation to do business with us. If you have us run one of these plans, all we ask is you help us grow our business by recommending some of your coworkers also spend some time with us. And that's how we've grown our business the last 30 plus years. If you'd like to get in touch with us, you can email us at info@theretirementgroup.com. You can call us at the home office. Our number is 800-900-5867. You can take a picture of this QR code if you have a smartphone. The one on the left will get you onto mine or one of my colleagues' calendars for a 15-minute consultation, or we'll ask you the questions that we need to get answered to run your cash flow analysis. And then again, here's that LinkedIn page QR code. If you just like to learn more about different retirement planning strategies, some specific to the AT&T benefits plans, encourage you to follow us on LinkedIn, because that's where we publish these webinars that we do throughout the years. So with that, Sam, if you're still there, if we have any questions, I'm going to pass it back to you for any questions that came up on today's webinar.
I am still here, Tyson. The first one, we'll try to make this short. What's the best way to take money from my pension and AT&T 401k savings during early retirement so that I have enough income and don't have to worry about taxes?
That's a good question. It's going to depend on your situation, primarily your age. We talked a little bit about ways to get money prior to 59 and a half without the penalties. It's going to also depend on the state that you're in, because some states do tax retirement account withdrawals. Some states that have a state income tax don't tax retirement account withdrawals, as it turns out. But there's a lot of variables there. And my answer to that is have us run a cash flow analysis so we can understand your situation, tell you exactly what we think based on your circumstances.
Great answer. Number two, what happens if I choose not to return to office at AT&T? Can I be fired? And if so, can I claim unemployment?
Yeah, that's a great question. Some people it's not going to affect, but there's some that don't adhere to AT&T's request to return to the office. You won't be fired, quote unquote, but you will be without a job. So I don't know how you want to call that, laid off, I guess. The surplus, it's a part of the traditional surplus program as far as I've seen so far, where it appears people will be getting their traditional severance package up to 6 months pay, depending on your years of service. Question was, do you qualify for unemployment? And my guess is probably. If I were in your shoes, I would probably be applying for unemployment. In my experience, in 100% of the cases, and this is over 100 people, a couple hundred people probably that I've worked with through this, in 100% of the cases, the people that lost their job at AT&T ended up being accepted for unemployment and getting benefits. And I believe in a lot of places, it's over $500 a week for up to 6 months. So definitely worth a few minutes of your time, even if you get rejected at first, and make sure you answer all their questions honestly when you're going through that. But in my experience, people, even those that got a severance package, and I've had clients that left the company voluntarily. They raised their hand to get a severance package and still qualified for unemployment. In this case, this is involuntary because you are essentially choosing not to uproot your family and move to another city. My guess is you'll probably get accepted for unemployment. It's worth a try.
Alrighty, last question. If I'm not eligible to take my pension, how would this impact me?
Yeah, good question. So I would ask, why aren't you eligible to take your pension first? And it could be because you're not vested. That person might be eligible for their pension, but they're not mod 75. So it's a rather small pension compared to what it would be once they get pension eligibility. That might be somebody who that needs to at least evaluate what's the value of waiting until mod 75 or service pension eligibility, and comparing that to what's the cost of staying at the company. And the cost for a lot of people is going to be moving to another city. This is not going to be feasible for some people, but you've got to understand what you stand to gain or lose by staying or leaving the company. And so again, sounding like a broken record, call us. I want to know more about your situation before I can guide you on that. And it'll probably entail us running some pension projections on the net benefits website to look at some different timing issues, what your pension's worth at different points in time, and then we'll be happy to put a plan together for you.
Alrighty, thank you, Tyson. That was all the questions that we have time for today.
Great. Well, thank you, Sam, for helping me out today on the webinar. Thank you, folks, for attending our webinar today. Everybody have a good, safe rest of your week here, and we hope to talk to you all very soon.
Thanks, Tyson. Thank you, everybody.